you've joined us for our past webinars and that you're going to join us for our future webinars as well. So again, with a few housekeeping things before we get started here. So first and foremost, if you are here for CPE credit, we do need you to do a few things in order to receive that CPE credit. The first thing that we'll need you to do is answer our poll questions as they pop up on your screen. So I will give you lots of reminders that you'll need to do that. If you're having problems with those pop-ups on your screen, don't worry about it. Send me a message and we'll get that sorted out for you. The other thing that we'll need you to do in order to receive your CPE credit is to fill out the survey at the end of the webinar. There are a couple ways that you can do that. The first way you can do that is by filling it out as it pops up on your screen when you're leaving the webinar, or you can wait 24 hours and it will be emailed to you. No need to fill it out both times, but we'll need you to do both in order to receive your CPE credit. A few other things to take note of here. If you have questions as we go along, please ask us. We will answer at the end of the webinar or email you after, but we will get your questions answered. We will also be sending out the slides once we get the ball rolling a little bit in this webinar. So you can look for those in the chat box. That's also where we will be linking the handouts from today's webinar. So that's just a little thing you can open up, and yeah, we'll do a quick introduction for Sales Tax and More and for Mike. Sales Tax and More is a full service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and or related needs. We do a lot of returns, registrations, consulting, research, and like our name states, more. So if you have questions about any of our services, please reach out and ask. We'd love to answer those questions for you. And a quick introduction for our founder and president, Mike Fleming. Mike's state tax knowledge is very well-rounded. He's one of the United States' leading authority when it comes to e-commerce, Nexus, service providers, and drop shipping. Over the years, he's literally assisted thousands of sellers, both foreign and domestic, with their state tax issues. Mike, if you want to take it from here, we can go ahead and get started.
Okay, thank you very much, Ellie. And got a lot of information to cover today. And the big question is, does a physical presence for sales tax even matter anymore? Hopefully, by the end of today's webinar, you'll see that, yes, it does matter, and it matters more than ever, as a matter of fact. So we're going to go through a lot of information. We're going to go through fairly quickly. We're going to cover Nexus definition. We're going to go over some court cases very briefly. We're going to touch on economic nexus, because that's going to be one of the reasons why people are getting found for physical nexus. So then we're going to roll into the physical nexus itself. We're going to talk about some obvious, physical nexus creating activities. We're going to talk about some less obvious. We're going to debunk some myths. We're going to go over some case studies. We're going to talk about how states find you or your clients, and then we're going to circle back to why physical presence nexus matters now more than ever. So lots and lots of information. And, if you act before states find you, then you've got a lot of options. But once a state finds you, your options are very limited. Your client's options are very limited. So the worst time to find out that you have issues is after you've been contacted by a state, after you've received a telephone call or a Nexus questionnaire or an email or regular piece of mail. Once the state contacts you, very limited options. So at this point, Ellie, let's start with our first poll question. And I'm going to turn off my camera. I get pretty animated when I'm talking and got my head going all over the place. I find that distracting. So I don't want to subject you to it. So I'll turn the camera back on during the questions portion of the webinar today.
Thank you, Mike. That poll question is up on your screen. We'll leave it open for a few more seconds here. You do have to fill out these poll questions in order to receive your CPE credit. Mike, we have a little bit of a spread here. Some people who know the basics. We even have an expert in the crowd. but a little bit of everyone in the audience today. So we'll close that out and move on.
All right, so we have a good mix. We're going to start off with a definition of Nexus. And Nexus is just a fancy word that means link or connection. So remember that as we go through this for you who are fairly new, for the people who are the Nexperts, this is a little bit of a refresher. But Nexus just means link or connection. So whenever we're talking about activities later on today, be thinking of things that can connect you with the state or link you with the state somehow. So Nexus is just this link or connection which must be present before state can require you to do anything, like collect its taxes, a sales tax or a seller's use tax, or pay its taxes even, like an income tax, a franchise tax, or a use tax. So unless you have this link or connection, state can't require you to do anything, which is why we say it all starts with Nexus. Because if you don't have Nexus, you've got no problems and no responsibility. State can't require you to do anything. Now, if you do have Nexus, it's not the end of the world. We just have to look at a couple of other things. You may have to get registered, and you may have to collect tax or pay tax in the case of an income tax. But it's not automatic. So maybe what you're selling isn't taxable. Maybe you only sell on marketplaces and the marketplace is responsible. So it all starts with Nexus, but it does not end with Nexus. And no Nexus, no problems, no responsibility, which is why we all need to figure out what our Nexus footprint is, or help our clients figure out what their Nexus footprint is. Problem is, many companies out there, and sometimes even their advisors, when I'm talking to accountants and other tax professionals, they don't know where their clients have Nexus, or the companies themselves just don't know. And sometimes they know it, but for whatever reason, they've decided not to take any action. And we're going to talk about why this is very dangerous, because the states are beefing up their enforcement units. They're beefing up the discovery units. And while they're going to be going after companies for, economic nexus, they're going to be finding all other types of nexus out there. So anyway, let's talk about a couple of court cases. We're just going to touch on them very briefly. These are going to be the court cases that, pertain to physical presence nexus. And the first one here that I want to talk about is National Geographic versus Board of Equalization. These are all U.S. Supreme Court cases, by the way. And this one here says the taxable activity does not have to relate to the nexus creating activity. That's the takeaway, and that's paraphrased. And what that simply means is, once a company has nexus, it needs to collect the tax from all business channels, not just the nexus creating channel. Good example of this, and this comes up a lot, you've got a wholesale company, and they've been doing business 20, 30 years. They got manufacturers, reps all over the place. And then they decide to sell directly to the consumer, and they decide that they are going to sell online. And on day number one, they're going to have nexus everywhere. Everywhere they have one of these manufacturers, reps, independent contractors, or, salespeople, because the wholesale business, that's the nexus creating activity. All of these people located all over the country. But the taxable activity are these new retail sales. So that's not related to the wholesale sales, but because it's all under one legal entity, then you need to collect tax on all of those new online sales. So taxable activity does not have to relate to the nexus creating activity. If it's all in the same legal entity, then once you have nexus, you have nexus. All right, so Complete Auto Transit versus Brady. A lot of times we get e-commerce sellers on here, especially FBA sellers, and they're on these forums, and, they're listening to each other, misquoting different cases out there, misquoting, that, only Congress has the right to tax interstate commerce directly. And, they're correct. If you go back, 90 years or so, even 90 years ago, the states didn't believe that you could tax interstate commerce directly. That started changing in the 1950s. We started seeing that concept being chipped away. And then in 1977, the US Supreme Court didn't come up with anything new. They just cobbled together all these previous cases. And they said, yes, a state can tax interstate commerce directly as long as it meets a four-pronged test. And it's a pretty easy four-pronged test. So since 1977, states do have the right to tax interstate commerce directly. Now, two other cases I want to talk about. Scripto, which is a 1960 case, and Tyler Pipe, which is a 1987 case. In this first case, you had Scripto, who was located in Georgia. They had 10 independent contractors working in the state of Florida. And the state of Florida said, hey, these 10 independent contractors are creating enough of a significant presence for you that it's creating a nexus. And we want you to start collecting and paying our taxes. And Scripto said, you're out of your mind. These people have no relation to us. We don't control them. How in the world can true third parties be creating nexus for us? Well, unfortunately, the US Supreme Court said the difference between an employee and an independent contractor is without constitutional significance. In other words, it doesn't matter what you call them or how you pay them. They're doing the same activities as an employee would. So therefore, yes, this can create nexus. And this is the beginning of attributional nexus or agency nexus. We keep it simple. We just call it third-party nexus. But if you hear these other terms, attributional nexus or agency nexus, this is what we're referring to. 27 years later, we have Tyler Pipe. And the state of Washington goes after Tyler Pipe. They're a Texas company. They say, hey, according to the Scripto doctrine, we think you should be paying our business and occupation tax and collecting our sales taxes. And Tyler Pipe said, oh no, this is not like Scripto whatsoever. This is, just one person, and they're not even representing us exclusively. And they're not very good at it because they hardly send us any business anyway. It's like they're almost a part-time. So the Supreme Court, unfortunately, again, comes back on the side of the state. And they say, I'm going to paraphrase the beginning, but the second part of this is very, very important. It doesn't matter what you call someone. It doesn't matter how you pay them. It doesn't matter if they represent you exclusively or if they represent multiple parties. It doesn't matter if they do it on a full-time or part-time basis. Here's what matters. Are they helping to establish or maintain a marketplace? And if they're helping to establish or maintain a marketplace, then that is going to be nexus, or it can be nexus creating. And the reason why this language is so important is because so many states have taken this language and incorporated it directly into their statutes or their rules, their regulations. They use it to provide guidance. The state courts use it as precedent when they're deciding cases. So lots of reasons why this language is so important. Now, both of these cases talked about solicitation, but we'll see how this has really grown into umbrella language, this helping to establish or maintain a marketplace. Okay, so let's talk about economic nexus very quickly. The link or connection we were talking about does not need a physical presence. It can be based on sales or transactions. We had South Dakota say they thought $100,000 or 200 transactions was sufficient to create this link or connection. Supreme Court didn't explicitly agree with that, but they said, hey, for South Dakota, it sort of sounds fair. And they sent it back to the lower court for a final, for them to work it out. It didn't get worked out. They settled the case before it got worked out. So we may see more litigation concerning, the exact thresholds, but I would not hold out. We have some companies out there. We have some advisors out there saying, well, they're going to get this fixed. Well, I don't agree with that, but how much pain and suffering are you going to, incur, or your client's going to incur while you're waiting for this stuff to get fixed? Non-taxable sales, often included. Sometimes they're excluded. Sometimes all non-taxable sales except for resales. So it's very different from state to state. As of now, all states have announced thresholds except for Florida and Missouri. They look like they're going to happen this year. Florida looks like they're going to have $100,000 or 200 transactions. Governor said that he's going to veto it because he doesn't want the taxpayers, the citizens down in Florida, to pay any additional taxes. I think someone needs to, let them know that this is not additional taxes. It's just, who's going to be in charge of collecting those taxes, whether it's, going to be the sellers, or, if it's going to stay on the shoulders of the actual purchases who are supposed to be self-assessing and remitting those taxes. I think the legislature has enough votes to override the governor. So if he does veto this, I still think that we're going to get some type of thresholds in Florida this year. Missouri, the governor looks like he's going to be supporting it. Last year, he vetoed it twice. Because they were tying it to tax cuts. So it should become effective in October 1st of this year. Looks like it's just going to be $100,000. Does not look like they're going to have the 200 thresholds. Kansas and Louisiana have thresholds. Louisiana put theirs on hold. Looks like that's going to be going live before July 1st of this year. Right now, you do have notice and reporting requirements that are live in Louisiana. It's a $50,000 threshold. In Kansas, we had the Department of Revenue come out and say, well, we know we don't need a physical presence, but the Department of Revenue does not have the ability to issue thresholds. And I'm sorry, I've got Kansas and Missouri here. Missouri, they tried to tie theirs to credit card collection companies last year, which is, it got stuck in the legislature. They weren't able to get it out. In Kansas, that's the state where the governor vetoed this twice because of ties to cutting the taxes on other items. The legislature looks like they're coming forward at this point. It looks like it's going to be $100,000. We'll see what happens, whether the governor approves it or not. But the Department of Revenue is still moving forward. Now, some of our competitors forgot the part that the Kansas Attorney General stepped in and said, hey, you can't do this based on one transaction. You got to at least follow the safe harbor of $100,000 or 200 transactions. So we've told our clients, if you do have, substantial exposure in Kansas, you should go ahead and get registered. But just keep in mind, they may remove that 200 transaction piece at some point later this year. Real important here, economic nexus is not an internet issue. It's a multi-state issue. So many people I talk to call this an internet tax. It's not. I mean, you could be selling purely by referral. You could be doing everything over the phone. If you're selling into multiple states, or who have clients selling into multiple states, this is potentially going to impact them unless they're already registered everywhere. This does not override any other type of nexus. Physical presence actually trumps economic nexus, and that's why this is one of the reasons why physical presence is really more important than ever. So many times I get calls and people are saying, hey, can I deregister here, or do I no longer have to be registered here? And, we get into the conversation, and they're telling me, well, I'm underneath the threshold. And then it comes out they've got a salesperson in the state, or they have inventory in the state, or some other type of physical presence. So physical presence is always going to override economic nexus. Economic nexus is just one more way for the state to get you to do what it wants. It's one more way to create this link or connection, but it doesn't offer you any any protection from any other type of nexus. All right, so Ellie's going to get this out for you. This is a chart. We keep it updated every time a state brings out additional information about their thresholds, and it's up on the on our website. So we'll keep it updated. But Ellie will also put it out in the chat feature for you. All right, so here's myth number 1. I don't have to worry about sales tax nexus if I'm under the economic thresholds. That may seem like common sense to some of you, but you would not believe how many calls a week that we get like this, or how many emails a week. All right, so let's move on to physical presence. And I mentioned earlier, we're going to talk about obvious and less obvious. We're also going to talk about common nexus creating activities, and then very state-specific nexus creating activities. When we say common nexus creating activities, we mean that the majority of the states, pretty much all of the states or most of the states, are going to consider that nexus creating. When we say state-specific, it's going to vary widely amongst the states. So let's talk about one that's both common and obvious, and this is real property. And I think we can all agree that real property can create a link or a connection with the state. So it doesn't matter if we own that property or we rent that property. It doesn't matter what type of property it is. Real property, very common and very, what I would believe, obvious. What's not so obvious is a virtual office. There's no real property involved here. And a lot of people, you know, I get calls all the time and from some very smart people, they tell me, well, Mike, I don't have a location. Everything's in the cloud. Well, number one, that defies the laws of physics, but the states are not going to take that as an excuse either. They're going to say, you yourself, you are creating a link or a connection. So where you live or operate your business from actually creates a link or connection with the state, and that's going to be nexus creating, and that's very common. That's going to be pretty much across the entire country. Employees. We have employees in a state. I think that, you know, using some, you know, logic, that can create a link or a connection. Even remote employees, there still are employees and they're in another state. Now, some states are going to look at what the remote employee does, but that's the exception, is most states consider having an in-state employee as nexus creating. So again, this is going to be very common. Some states go as far, you know, when we talk about employees, if they're in a state for greater than 48 hours cumulatively throughout the year, like in Arizona or Michigan. So employees can create this link or connection. All right, here's one that's not so obvious. As a matter of fact, this one defies common sense sometimes. You know, we started talking about this earlier. How can third parties, true third parties who we don't control whatsoever, how can they actually, you know, create nexus? And we have the two Supreme Court cases, you know, Scripto and Tyler Pipe. You know, and you know, sometimes I talk to people and they say, oh, I don't have any independent sales reps. And then, you know, during the conversation, I find out they have subcontractors. Well, it doesn't matter what you're calling them, whether they're manufacturers reps, whether they're independent contractors, whether they're subcontractors. Some people say, oh, no, I don't have any of that. And then I ask them a question. Well, yeah, I hired a third party. I hired a company to do that work for me. So it doesn't matter who's doing the work. If they're helping you to establish or maintain a marketplace, then that's going to be a nexus creating activity. And this is one of the greatest areas of exposure. You know, I've run across companies routinely who have had independent contractors for 10 years or more, and they don't realize that this is creating nexus for them, and they have all of this exposure. So I said that we talk about third-party nexus. And, you know, sales, okay, we've talked about that. The two cases that we talked about relate to sales, but there's a whole bunch of other activities that can be tied into this. So here's a list of them up here. By the way, this is not an all-exclusive list. There are more activities that third parties can do, whether they're subcontractors, independent contractors, or companies that they can do for you. What's important, I'm going to tell you what we tell our clients is if these, relationships are going into a state to perform work on your behalf, or if they're facing the public, then there's a good chance that they're going to be helping to establish or maintain a marketplace. If, a lot of times companies hire someone to develop software for them, and they hire them on an independent contractor basis. Now, that person's generally not going to be interacting with the public. They're generally not going to be going into another state to do work for you. So if someone's just, developing software, that's probably not going to be creating Nexus. They're not helping to establish or maintain that marketplace. Bookkeepers, same thing. You hire a bookkeeper on an independent contractor basis, generally not going to be creating Nexus for you. But, if they're doing collections or credit checking or customer service, all of these things, in addition to sales, training, installations, implementations, a good chance that's going to be Nexus creating. All right, so let's talk about our first case study here. And this is an Amazon seller, and this was, 6, 7 years ago. And this guy was an early adopter. He went out and registered everywhere that Amazon had a warehouse. Now, he lived in Missouri at the time, and his home state did not have a warehouse. So we said that independent contractors create Nexus. Well, states know that, and you usually pay your independent contractors with a 1099. So it's routine for states to go to the IRS and say, please give me a list of everyone in our state who's received a 1099. Then they look at who issued the 1099, and then they see if they're registered for any other types of taxes. Well, in this instance, Amazon issued a 1099. Once you reach a certain dollar threshold, I believe it's $20,000 is what Amazon uses, they're going to issue a 1099. So the state saw that. They saw that Amazon was the one who issued this. They said, oh, we got an Amazon seller, and he should be collecting all of the sales tax on his sales to the state of Missouri. They looked at their records, and he's not. So his, defense was, well, I don't have a location here in Missouri. I got a virtual office. I have no location. And the state, chuckled and said, well, you yourself actually create that link. So we helped him out. We got some things excluded from the audit, but, most of his sales were taxable. So, learn from others' mistakes. Most states are going to, consider this. So 2 takeaways from this. Number 1, virtual office does create a link or connection. Number 2, states are looking for people who have independent contractors in other states. Now, it's not just where your employees or contractors live, but anywhere they travel on your behalf, and we break this down into 2 groups here. If it shows up on an invoice, it's fairly easy for a state to find you. If it doesn't show up on an invoice, it's a little bit harder. So if you have salespeople traveling into other states, yes, that still creates Nexus. If these independent contractors are, going into other states to sell on your behalf, it still creates Nexus, but it's a lot harder for a state to find that. Not impossible. I mean, employees can tell on you. Your competitors can tell on you. They want to level the playing field. So you don't have an advantage over them because they're collecting tax and you're not. So you can be found, but it's much lower on the radar. Say that you're doing training or installations or implementations, that shows up on an invoice. Reimbursements for travel can show up on an invoice. So if one of your customers gets audited, right away, they're going to be looking at who issued the invoice, and you're on a list. And never good to be on a list. Not necessarily a bad thing, but states are usually following up on these lists that are created when an auditor is out there auditing your customers and or your vendors. So Travel is a fairly big deal. Yeah, well, let's look at a case study that can illustrate this. We had a specialized software company, and 30 years ago, the CPA told them the CPA and the owner of the company, they were fraternity brothers, so they've known each other for a long time. And the CPA said, Nexus is created by traveling salespeople, so don't let your salespeople travel, and you'll be okay. Now, both the CPA and the company were in a state that didn't have a sales tax, and this was 30 years ago. So, you know, it's they were talking about what they thought they knew, and for 25 years, there were no problems. And that's usually the way this is. It's never a problem until it is. And they were contacted by a state next door, and the state said, hey, you know, we believe that you have Nexus. And the company's response was, no, we don't have Nexus. Our salespeople don't travel, you know, so I don't know what you're looking at, but yeah, we do business in your state. We've been doing it forever. But we don't have Nexus. And they said, well, I'm looking at an invoice here. We audited one of your customers, and you're being reimbursed for travel expenses. And it says you're doing training and you've installed some equipment, and these are actual taxable services in our state. So we want the last 8 years of tax plus penalty plus interest. And at this point, the company had an epiphany, said, oh my. And they asked the state, they said, are all states like this? And the state let them know, unfortunately. And that's when we got the call. And this company was, you know, they were basically in tears. We had to talk them down off the ledge. And they said, based upon the numbers that, you know, they had to pay in this one state, that they're going to have $15 million or more in exposure. And that would bankrupt them. And, you know, their bank would actually pull their credit lines when they disclose this. So anyway, we talked them down off the ledge. We told them that there is a path forward. You know, we could do some, at that point, there were a couple of great amnesties going on. There were, you know, VDA programs we could take advantage of. We could restructure their invoices. You know, because if you're doing lump sum invoices, sometimes the entire invoice becomes taxable. So anyway, they asked us to speak to their bank, and the bank said, okay, you know, we're not happy, but we're in so deep, we're going to loan you the money to get this taken care of as quick as possible. Because a lot of times if you've got to do a VDA in, you know, 40 plus states, you got to do it, you know, 3, 4, 5 states at a time, because it can get pretty expensive. Voluntary disclosure is a VDA. The state rewards you for stepping forward voluntarily. They're going to limit the amount of years they're going to go back, you know, to 3 or 4 years rather than, you know, 7 to 10 years. They're going to waive the penalty and or some of the interest. So a VDA is a great tool, but this particular company, when all was said and done, you know, they paid a little bit more than $1 million. I've never seen a company so ecstatic, so happy that they paid $1 million or so. And they paid us a good amount of fees. But these were guys who thought they were going out of business. They thought they were going to jail at one point. So for them, this was a great outcome. Now, no one wants to pay money. But when you've already been found by a state, and states do share information, they were just, you know, saying, oh my, there's no future for us. But they're in business still, and they're going strong. So let's go to myth number 2. It's never been a problem before, and we've been doing this for, you fill in the blank, however many years, and it's not going to be a problem now. Unfortunately, I can tell you case after case after case, companies been doing this 10 years, 15 years, 20 years, 25 years, and it's never been a problem before. And it's never a problem until it is. So that's myth number 2. All right, so ownership or rental of tangible personal property. If you lease or rent to others, or you have clients who do that, And, you know, they're leasing into other states. You now own property in another state. So this could be, you know, inventory, could be equipment. This is a very common Nexus creating activity, you know, owning property in another state. If you own something in a state, that's creating this link or connection. So companies that are doing a lot of leasing or rentals are impacted by this. Let's do another case study here. We've got a camera leasing company, and they lease high-grade camera equipment all over the country. The state of Massachusetts found them, and they said they had Nexus due to owning tangible personal property in the state. And the company said, we can't be doing it wrong. Everybody in our industry does it this way. We don't pay tax in any states. Well, Massachusetts said, get us a list of everyone in the industry, and we're going to go after them all also. But yeah, you have Nexus in the state, and we want the last 8 years worth of taxes, penalty, and interest. So we happened to get a call the way that we found out about this story. One of their competitors called us and said, hey, we just got contacted by the state of Massachusetts, and they said one of our competitors turned us in, and, you know, that our the equipment that we're leasing to people in the state of Massachusetts creates Nexus. And is this true? Unfortunately, we had to tell them yes. And they said, what about other states? I said, you know, yeah, pretty much all the states. So with this company, we did help them out in all of the other states. We helped them out in Massachusetts, got the numbers down a little bit, but what they were doing was taxable. You know, sometimes there's just not anything you can do when a state finds you and they reach out to you. Your options are limited. So in all of the other states, we either got them registered prospectively going forward, or we did some sort of voluntary disclosure agreement with them and got them compliant across the country. Trade show attendance, going to differ greatly by state. And there are 5 basic thresholds for states or ways that states look at this. So there are some states take a very aggressive position and say, hey, if you attend a trade show, even as a consumer, that's going to be Nexus creating. Now, I think the states would be hard pressed to make that stick, but they still say it. And some people register because of that. If you're coming to us, we're going to say not worry about number 1. But number 2, participating as an exhibitor, that is creating some sort of link or connection. Some states, you know, make a distinction between being an exhibitor and solicitation. To me, that's a hard to determine between the two, but the states do. They say you can be an exhibitor, but once you start actively soliciting, then that's going to be Nexus creating. Then you have other states that say, hey, you can actively solicit so long as you don't take orders. Once you start taking orders, then that's going to be Nexus creating. Then you've got Nevada, who wants everyone to go to Las Vegas. They say you can, you know, participate as an exhibitor. You can actively solicit. You can take as many orders as you want. You can even make delivery and accept payment at a trade show, so long as you don't do that more than once a year. All the other things, no limit. But if you're at a trade show and you're, you know, delivering the product and taking the money at the trade show, they want you to collect the tax. And so long as you do that less than 2 times a year, 1 time a year, you just do that. No other responsibilities. Now, the way that you turn in the tax is give it to the promoter at the end of the show, or when you get home, if you miss the promoter or the promoter is not accepting it, you just send it into the state. Do that twice a year, you have Nexus. When we talk about de minimis levels, states generally don't talk about de minimis levels very much at all, except when it comes to trade show attendance. There are quite a number of states who say if you're here less than 3 days a year, or if you're here less than 2 weeks a year, then that is not going to be Nexus creating. Some states say if you're here less than 2 weeks a year and have less than $100,000 in sales that are generated from those trade shows or conventions, then that is not going to be Nexus creating. They're going to call that de minimis. But not all states have a de minimis exemption, and the states that do, it varies differently from state to state. So this is something that if you have clients who are going to trade shows, if you yourself are going to trade shows, you really got to do a state-by-state breakdown on this. Delivery in your own trucks. This is huge. There was a company that was located in the state of Washington. This was in the Washington Business Journal. Actually, they were located in Oregon, and they were, making deliveries into the state of Washington. And a lot of states put revenue agents at their, way stations, at the state crossings on major highways. And when they see trucks coming in, they can tell who it is. They make notice of it. Sometimes, they'll impound the goods, at the way stations. So we've gotten many a call where, especially up in New Jersey, where we've had to, help the company quickly get a bond in order to have their goods released. Ports in California, same thing. So very, very common nexus creating activity. If you're delivering in your own trucks to a location in that state, then that's generally going to be nexus creating. Driving through a state, not going to be nexus creating. It's only when you're making the delivery into that particular state that's going to generally be a nexus creating activity. Inventory. I know if you've got clients who are Amazon clients are going to say that they don't believe that inventory creates nexus. Unfortunately, in most states it does. Whether they say that you own tangible personal property, which we talked about earlier, or whether they say that the inventory is consigned. I mean, whether it's carried or stored by sales representatives, a lot of states specifically mention inventory. So the argument that a lot of Amazon sellers make is that Amazon should be collecting and paying the tax because this is like a consignment sale. Well, okay, I get that. I don't disagree with that. But consigned inventory still creates nexus. So just because Amazon's collecting, and now they are collecting in most states, doesn't mean that your nexus goes away. So if you're selling on other platforms, then there could still be a nexus created by this inventory. Now, states are starting to look at whether the inventory is self-directed or not. So that may play a role in some states going forward. But as of now, vast majority of states still just say if you have inventory in the state, that's going to be nexus creating. So related entities, just think if third parties can create nexus, how much easier is it for a related entity? Some states say that if they have common names, similar names and products with common ownership, that's enough to create nexus. Other states say they have to be performing services for each other. And when I'm talking to companies or accountants, they often say, oh no, these, they're not performing services for one another. So my follow-up question is, are they being operated independently? And they are, is the answer, until I start looking at some of their books and records, and lo and behold, they're doing journal entries to move inventory from one company to another. That's not separately operated companies. I mean, you got to have actual sales transactions. So be careful if you're creating related entities in order to avoid creating nexus. All right, click-through nexus. New York started this phase. They went after, Amazon and Overstock.com. And what they said was, in Tyler Pipe, we had one independent contractor steering business. With Amazon and Overstock.com, you have a whole state full of people sending the company business, and they're being paid a commission or a referral fee or something. There's no difference between the Tyler Pipe case and what these, individuals are doing. And the highest court in New York agreed with that. And it, was appealed to the U.S. Supreme Court, who refused to hear the case. So that was back in 2008. 21 states followed or so. At this point, some states with the, economic nexus being introduced, some states are backing away from click-through nexus, but some states still have this. And a lot of people have right on their websites, they're announcing that, hey, we've got an affiliate program. We allow people to steer us business. If some states actually scour the website to find you. So that's not good. If they see that you have a click-through program, they can come after you. And it's not going to be Economic Nexus, which is, roughly 18 months old in the earliest states. They may be, going back 11, 12 years. So we've got to look at, which of our clients or which, whether we are announcing that we have these affiliate programs on our website. All right, so downloaded software. Here's a case of a state really stretching. Texas considers software to be tangible personal property. They define it in their statutes. Even when downloaded, it's still tangible personal property. And when you license software versus selling it outright, you still have an ownership interest. So when a customer downloads your software, you now have ownership of tangible personal property in the state of Texas. This was, backed up by an ALJ here in Texas. It was back in 2014. This is well before Economic Nexus. This was an end run around Economic Nexus. We think that, this was a gross violation by Texas. And some people took them to court. And every time it went to court, Texas settled in a sealed, settlement. And they continue to do this. So if you took them to court, they settled with you. If you didn't take them to court, then you had to pay. So if you're selling software in the state of Texas, be very, very careful. They're very aggressive. All right, so here are 10 common Nexus creating activities. This is a list. It's up on our website. Ellie's going to share it with you. We've gone over most of those. Here are 12 state-specific Nexus creating activities. Most of this is going to be self-explanatory. If you do have any questions, let us know. But Ellie's going to share this with you, and it's up on a free portion of our website. And Ellie, let's go to the next poll question.
Absolutely. Just a quick question here about what about sales tax Nexus concerns you the most? So we'll leave this open 15, 20 seconds here. We had somebody in the crowd wondering how many poll questions we've had so far. This is our second poll question. We will have one more. You do have to answer these questions in order to receive CPE credit. We'll leave this open about 5 more seconds. Most people are concerned about Economic Nexus here, some about third parties and travels, but we will close this and move on.
Okay. So let's go to how do states find you? Well, if you're selling to businesses, one of the biggest ways that states find you is by auditing your customers. When an auditor comes out, they're looking not just at your sales to make sure that you're taxing everything that needs to be taxed and that it's at the right rate and that you're turning everything in that you collect. They're also looking at your purchases, because just because your seller does not charge you a tax doesn't mean that it's tax-free. Maybe it is. Maybe you're buying it for an exempt purpose, but maybe you should be self-assessing and remitting the tax as a consumer use tax. So use tax is like the number 2 reason for large assessments in an audit, because companies are not paying it. Individuals are supposed to do it too, but we don't audit individuals, so they generally don't, submit any use tax. But companies, especially, companies that realize they have exposure are setting up systems where they can self-assess and remit the use tax. We talked about information sharing with the IRS. They very often, ask for that list of 1099s, but information sharing with other states, especially in the Southeast. If one state finds you, they're probably not going to get calls right away. That state wants their money first, and you're probably not going to get called by every state in the country. But don't be surprised if 6 months later you're getting calls from 2 or 3 other states, because they do share information. Amazon tells them, California demanded information from Amazon. Massachusetts demanded information from Amazon. Wisconsin demanded information from Amazon, and they provided that information. Web surfing. Some states, have their discovery units, which are the units that, look for taxpayers that are not currently paying tax, crawl the web. Some of them use sophisticated software programs looking for words that would make it seem like you have nexus with that state. And then leads, former employees, competitors, sometimes a customer. If you're not charging tax, they're going to call up the state and say, hey, do I need to be self-assessing and remitting the tax? My vendor didn't charge me tax. Next thing you know, the state's saying, who's your vendor? And you're on a list. And these discovery units are the ones who follow up on that list. Maybe you didn't have a responsibility. Maybe you don't have to worry, but you are on a list. So just remember that. And nowadays, some states are even buying lead lists. The state of Utah has purchased a lead list of people who they believe are over their thresholds. It's $100,000 or 200 transactions. Their thresholds became effective January 1st of 2019. And they're calling everybody on that list. And here's one of the problems. Why does physical presence nexus matter now more than ever? And we've been touching on this. So many of these states are doing like Utah. They're gearing up to track down sellers. I mean, they've been waiting since 1992. They've been trying to figure out how to get, these remote sellers. And they're salivating at this point. They're like kids in candy stores. And they're gearing up to track down sellers. It's already started. It's going to get a lot uglier over the next 18 to 24 months. They're going to start making examples of people. And here's one of the big problems. This is why physical presence matters. I mean, it's bad enough if a state finds you, like Maine, and you've got 18 months worth of back exposure, and Maine is auditing everybody at this point. South Dakota, same thing. They're November 1st of 2018. So maybe 13, 14 months on that one. But the states are going to stumble across all types of nexus. And, maybe you've had an independent contractor for 10 years. And in some states, they routinely will go back 10 years. In theory, they can go back to the date that the nexus actually began. We had a company in Texas. Texas usually only goes back 7 years. But for this gentleman, they decided that they wanted to go back 12 years. And he was selling pool cleaning services in the state of Texas, which are taxable. And he was about to retire. And, a lot of people say, well, I'm not big enough. I mean, in his best year, he might have done 70,000, and that was not his profits. That was his revenue. And this was the type of guy that, when he went to his CPA every year, he bought a box of receipts. I mean, nothing electronic or anything. And they're asking him for 12 years worth of back tax, penalty and interest. Well, first of all, they're going to ask you for 12 years worth of records. And if you don't have records, they're going to estimate. And what's that mean? They make up the numbers. So, just because the state generally will go back 7 years doesn't mean that they're limited to that. And some states go back 8 years automatically. Some states go back 10 years. I don't know of any states that go back 9 years. And once the state contacts you, a VDA or similar type programs are not available. So if you do have a lot of past exposure and you're worried about being found, you've got to be proactive here. And at that point, Ellie, I'd like to open this up to questions.
Absolutely.
We've got to do poll number 3. I'm sorry.
Yes, I'm going to launch that right now. A quick true or false question here. We'll leave this open 15, 20 seconds. And remember, you do have to answer these questions in order to receive CPE credit. Mike, we'll leave this open about 10 more seconds, but if you have anything else you want to go over today afterwards, then that would be a great time. So we'll close this out. Most people are answering false. I don't know if you want to go over that, but.
That is false. Do we have any questions at this point, or?
No questions. So if there's anything else you want to cover, now would be a great time.
Let's talk about a couple other myths. So myth number 3, registering for sales tax automatically creates income tax nexus. And this is false. A lot of the same activities that create nexus for sales tax do create nexus for income tax. But registering for sales tax is not an activity that creates Income Tax Nexus. Income Tax Nexus has a different set of rules than Sales Tax Nexus. You can have Nexus for income tax and not for sales tax. So this is not an automatic. So a lot of people I hear, well, I don't want to register in all of these states out here, you know, because of economic nexus, because I'm automatically going to have to, you know, pay income tax. Well, that's just not true. In addition to it not creating nexus, there are, you know, if you truly are just selling tangible personal property in these states, then you're protected by Public Law 86-272. So this is a myth. Don't let your clients you know, worry about income tax, because the income tax exposure is generally a whole lot less than the sales tax exposure anyway, because the sales tax exposure could be coming out of your client's pockets, excuse me, your client's customers' pockets, and it's based upon the gross sales. So you generally have a lot of more exposure for sales tax, and someone else could be paying it, than income tax. Income tax is generally going to be based on, you know, your profits, your net income. And that's always going to come out of your pocket. So a lot lower numbers there than there are for sales tax. Your exposure for sales tax is generally going to be a lot larger than it is for income tax. All right, here's another one. Myth number 4, you have to register with the Secretary of State when registering for sales tax. And this is just unfortunately false. And too many people out there are telling their clients, you have to get registered with the Secretary of State. One of the reasons is that the state websites make it look that way. But if you call the state, or if you dig around on the state website enough, you'll see how to register without registering with the Secretary of State. Now, if you have employees in a state, if you have a physical presence like a building or something like that, then generally, yes, the registering with the Secretary of State could be required. But if you only have an economic nexus, or you only have salespeople traveling into the state, then no need to register with the Secretary of State when registering for sales tax. So that's a big, big myth. Now, I want to talk about one other thing. And this is called materiality. So states don't say this. States generally want you, once you cross the threshold, they want you collecting their tax. But I say we have to use common sense. And if the cost of compliance exceeds the back tax plus penalty and interest, does it make sense to file? For example, let's look at economic nexus. That's a lot easier. For a quick example, you sell 200 items, it's $5, so you got $1,000 in sales. The tax on that, the state says you should collect it, but the tax, depending on the state, is going to be somewhere, I don't know, $60 to $85, maybe $90. Does it make sense to jump through hoops to get registered? And then once you're registered, some states automatically make you file on a monthly basis, like in Georgia, first 6 months, you are monthly no matter what. You're better off waiting for the state to come and find you because you're going to pay the state a lot less money out of your own pocket. You'll have to pay the back tax, you'll have to pay the penalty, and you'll have to pay the interest, but that's still a lot cheaper than the cost of compliance. So we've got to use common sense when we're approaching this in pretty much all situations. When your exposure is material, and that's going to be different for every company out there, then we most definitely say that, yeah, you need to register. Because, whenever we're doing tax planning, it's just a lot easier to yes, there is a cost of compliance, but the cost of compliance is going to be so much less than the back tax penalty and interest if a state finds you if your exposure is material. So quick rule of thumb that we use is that for every $1,000 of sales you have roughly $120 worth of exposure. Now, this is a very 10,000-foot overview, a real quick way to look at this. We base that on an average sales tax rate of 8%, and then we look at 50% of that 8% being penalty and interest. So you're looking at an effective rate of 12%, so $1,000, 12% of that is $120. And you don't want to look at this as if the state's finding you this afternoon. You want to look at this as if, what happens if you got 3, 4, 5 years of exposure? So at $1,000, you know, you got $120 worth of exposure. It doesn't matter if this is 4 years, it's still $480, and you would have had the cost of compliance every year. But if it's $10,000, now you're looking at $4,800 4 years down the road. The cost of compliance every year is going to be substantially less than that $1,200. And now, you know, maybe they share the information with 2 or 3 more states so that, you know, potential $5,000 exposure now becomes $15,000 or $20,000. So we do believe you need to be very conservative when it comes to getting registered for sales tax, but we still have to use common sense. And at this point, Ellie, I'd like to end it and thank everyone for coming today.
Yeah, I would like to parrot that as well. Thank you everyone for coming. We always appreciate your attendance at our webinars. We hope that you join us for future webinars, and that if you have questions, do please reach out. We also are offering online interactive workshops. They are part of the premium portion of our website if you're part of that. Otherwise, they are a great opportunity to interact with Mike as he's going through a webinar. They're 2 hours and 2 CPE credits each. Mike, am I missing anything about these workshops?
The first one is how to do a Nexus review for yourself. We're going to do an economic Nexus review, and we're going to do a physical Nexus review, or how to do it for your clients. And we're going to share all of the tools that we use to do it ourselves. And we're going to take you through it step by step. So that's the first one. I believe it's going to be March 6th. And we're going to be doing at least 12 of these a year. So that'll be 24 CPE credits. That'll be roughly $199 per class, but they are free if you're a member of our Salt Vault, which has lots and lots of resources that the people who are currently members of the Salt Vault find invaluable.
And that's 12 different webinars throughout the year. So this is the only time
Workshops,
this year.
Ellie, workshops. Webinars are free. We're going to continue to do these free webinars. If you have any ideas for additional webinars, let us know. The workshops are going to be more detailed than the webinars.
Much more detailed, and we are only doing this specific online interactive workshop this March. So if you want to be part of it, I would jump in and get on it. So we'll email out some of that information so you can learn more, and we hope that you join us.
Thanks again, everyone. Bye-bye.
All right, have a great afternoon.